Welcome to everybody that's joining. We are going to give it just a second and let everyone filter in. Thank you for joining us today. All right, it looks like we still have a few people filtering in, but we're slowing down a bit. All right, so welcome everyone. You have joined Tax Planning During Uncertain Times, and I would like to introduce our presenters, Dan Packard and Tim Anderson. Go ahead and get started, guys.
Thanks, Brooke. Appreciate the opportunity to be with you today. Really fun topic. Tim Anderson and Dan Packard webinar devotees will notice that we've switched it up a little bit. Tim now looks like a U.S. Senator, and I look a little bit more casual today. Normally, I'm the one rocking the suit jacket instead. So we thought we'd mix it up a bit. So anyway, excited to cover today's topics. I'm going to go ahead and share my screen now.
I will say that the original name of this webinar was Tax Planning for an Apocalypse.
It was. It was. That was, if Tim was left in charge of all decisions here, that's what it would have been.
Obviously, I don't make these slides.
Excited to be here today. There's, Tim, what I've noticed is that about every 4 years, tax planning feels abnormally important. This, I think, is one of those years where tax planning feels pretty important. What do you think are some of the contributing factors in your mind that makes tax planning in 2020 unique over any other year?
Well, there's so much instability on so many fronts. The economy being one. We're hearing reports now of people that have had just a watershed year in their business. Businesses are failing left and right. Mm-hmm. The uncertainty surrounding economics, all aspects of economics, in addition to who is going to be establishing tax law in the immediate future. So a lot of question marks.
Election year, massive amount of tax legislation that came through, economic uncertainty. Honestly, I can't think of a better year really to invest in some tax planning this year. With that in mind, I think the goals that I have for today, Tim, are that I want to raise some awareness over variables that we're looking at in tax planning. What are the things you need to be aware of when you are tax planning? What are the things that we still don't know in pending legislation, and then what are I want everyone that watches today to come away with 2 or 3 ideas, just something that they can take to the table when they're sitting down with Cooper Norman, doing their tax planning, saying, hey, I heard Tim and Dan talk about this. Is this something that could be a fit for us? Something I like to say to my clients is that I want every year to have something new to talk about. I think this is an effort for us to say, here's some ideas, take something to that meeting that interests you, something that you might think would be a good fit.
Okay.
Why don't we start with what you had mentioned, that this is a year of election. There's uncertainty really as to really what our tax laws are going to be in the future. We've heard some of the platforms from Biden, from Kamala as well, things that they would plan to implement in the event that they're elected. We've also heard from Trump, his support of existing tax law that he's put in place, but maybe some indication of things that he wants to modify. It being an election year, what kind of taxpayer do you think is perhaps overly concerned about the election and maybe the timing of certain transactions?
Well, I mean, that's a great question because, as we introduce this idea of presidential tax platforms, my question is why? Why talk about it now? That's something down the road. But I think it does impact certainly small business owners who have some flexibility as to when they recognize income and deductions. Definitely what the candidates are proposing now will impact 2020 taxes and what's the most prudent action to take.
Absolutely. When I was watching the presidential and vice presidential debates, 400,000 was a number that was thrown out a lot. And I thought to myself, if I'm a taxpayer that is around that $400,000 number, I certainly would want to do some tax planning, or at least understand what ramifications there really are, what kind of breaks they're talking about with business owners.
Definitely.
When those perhaps additional taxes would kick in. So what we put together here is a summary of what we know about each of these platforms right now. Biden's positions on some of these are still, there's certain elements we don't know really the entirety of it, but let's spend some time vetting it out. We're familiar with Trump's positions on income tax brackets. We got 10 all the way up to 37%. He increased that amount up to $622,000, people entering that top tax bracket at $622,000 if you're married filing joint. Biden has indicated that he only plans to increase taxes for individuals that make more than $400,000. I guess that impresses on my mind, I wouldn't anticipate any rate changes on any individuals that are under that $400,000, but I can't, that's merely speculation at this point. We do know that he wants to raise the top tax bracket back to 39.6. That number sound familiar to you?
Oh yeah, we've had that rate for over 2 decades.
We have. That was a rate that was in place, Bush era, Obama era. Truthfully, a lot of his proposals sound a lot like Obama era tax initiatives. Even his $400,000 number is the number at which, during the Obama era, the taxpayers entered into that top tax bracket.
That's a good point.
Which is why I ask, is he going to honor and stay at that $622,000 top tax rate, top bracket, I'm sorry, or is it going to be some amount less than that, maybe $400,000? I don't think we know at this point.
Yeah, and I would guess that the two groups, I mean, there's an exponential difference there as we look at people earning in that bracket.
Absolutely. So tax planning, certainly saying, okay, in the event that Biden were to win the election, expect an increase in the top tax rate, perhaps expect a modification at which point you enter into that top rate as well. Capital gain rates is something that's been discussed very actively. Trump's current position is 0, 15, and 20% for capital gains, where you enter that top rate at $496,000. Biden has indicated a change of that 20% rate up to 39.6 for those that have over $1 million of income. Now, this is kind of where tax terms of art, I think, can kind of make things hazy for you and I as CPAs. His exact wording was 39.6 for taxpayers earning more than 1 million annually. What does it mean to earn more than 1 million annually? Is that adjusted gross income? Is that taxable income? Is that some average that he's going to be looking at?
Very good questions. I mean, yet to be defined. I think it all plays back to, years ago when, Warren Buffett said that he pays more in taxes than his secretary. And this would directly affect investors like him.
So we may see maybe some other metric, them looking at some metric that we're unfamiliar with and determining whether or not you have to pay that top tax rate.
And here again, for decades, the top capital gains rate was 28%. It's only been recently, since President Bush, that it was lowered. So I think, it has a tendency to creep up or be attacked in future presidencies.
What kind of transactions, let's say a business owner is coming into Q4, what kind of transactions, I guess, would be at a point of consideration given what we know now about capital gains rates and each of their potential modifications to it?
Well, I would hope that any future legislation wouldn't be retroactive as a detriment to the taxpayer, but there's always the chance. So if I was anticipating selling property, any other type of investment property, I would consider selling it before December 31st, or having it in the books, or using some sort of vehicle that would allow me to straddle the year end and decide which one I take.
I like that. Something else to consider is that a lot of taxpayers have installment agreements that are in place right now that have been for several years, where they're receiving payments for, let's say, a property or a business that they sold in the past, recognizing a capital gain every time they receive those proceeds. This may motivate some of them to accelerate installment agreements that they have, to harvest that gain in a year where the rate is much lower than it could potentially be.
That's a good point.
Hard to say really what's going to happen there. Good news is that within the next couple of weeks, we should have a good idea where we're coming out, leaving, I hope, adequate time to tax plan and plan around what outcome we end up harvesting. One thing, Tim, that has been discussed really on the fringes, just because I think a lot of people don't understand this tax topic, is the step up in basis that Biden has talked about only, not infrequently. It hasn't been it hasn't been his top tax platform that he's discussed, but infrequently he's talked about modifying what is known as a step up in basis upon a decedent's passing of their estate. Can you try to simplify something like this for our listeners?
Well, the last great tax loophole has been death. Anybody receiving property as an inheritance is able to establish a basis in the property they receive at fair market value on the day they inherited it. So, if you were to receive mom's house at the day of her, when she passes away, it's as though you purchased that house for fair market value on the date of her death. So if you turned around the next day and sold it, there would be no income tax to pay on that house.
Whereas if she sold it, let's say a secondary home or something like that, if you were to have sold it while she was living, she would have recognized a capital gain upon that transaction. So really, this step up has been a massive benefit to the decedent's heirs that receive this property, subsequently wanting to liquidate it or even hold it to have a reestablished basis that reflects fair market value upon that individual's passing has been massively beneficial.
And I would expect that if something like that were to go through, that it would turn estate planning on its head, that suddenly we would be using different vehicles as to pass along property to subsequent generations.
I see this impacting gift tax strategies, estate tax strategies, and really just the liquidity of property in general. I think that, oftentimes people may have felt motivated to wait until one's passing to dispose of an asset, piece of land, perhaps a business interest as well. You take that away, I don't know, a lot of those motivations effectively go away. I see an impact really on the market in general.
And, we're going to get to this in a minute, but there are a lot of question marks surrounding the estate tax. As it relates to this election.
Let's circle back on that. Next item here of discussion is individual incentives. Trump has had in place since 2017 a $2,000 credit per child tax credit, and it was enhanced from $1,000 per child. He also made it available to individuals that made up to $400,000 as well. Far more individuals were getting this credit than historically were ever getting this credit in the past. He enriched the earned income tax credit as well, maxing it at $6,500, and also had a child independent care credit, which really didn't change much from what we had in the past. Biden has made indication of an $8,000 per child credit up to $16,000. So say you have 3 to 4 children, I'd anticipate that the benefit would cap at $16,000 based on how he's presently constituted it. Given his, I think, proclivity to look towards Obama-era tax laws, I'm wondering if he will modify the taxable income or the adjusted gross income at which individuals actually will get this credit. Back then, it was hard for individuals to enjoy that credit. They made more than, I think it was $180,000.
And it was phasing out.
Yeah, it was. So we may see an increase in enrichment of this credit, but a simultaneous reduction in that, I guess, that ceiling at which people enjoy the credit.
I agree.
I really don't know what he's going to do with the earned income tax credit. My guess is that it will either remain the same or be enriched. There's talk of a $5,000 credit for caregivers of individuals that are in need of physical or cognitive needs. So attention.
Yet to be determined.
Itemized deductions was one of the large things that Trump changed in 2017. He repealed what is known as the P's limitation, which limited the effectiveness of certain itemized deductions for high earners. He has no intent of modifying that if he were to remain in office. Biden would reinstate the P's limitation for taxable incomes above $400,000.
Yeah, and for years there's been complaints that higher earners are able to significantly modify their income, their taxable income, or the amount of tax they pay by making charitable contributions, paying a lot in mortgage interest, along those lines.
Mm-hmm.
So that again used to be phased out, beginning at $300,000 for married taxpayers, $180,000 for single people.
Right. So we're back to this magic number, this $400,000 number. It's a recurring theme in Biden's tax proposals, is that $400,000 seems to be the area at which he's really focusing. Payroll taxes at present, most are aware that the FICA tax is at 12.4%. That's split between the employer and the employee. That 12.4% tax caps out at $137,000. So in other words, if you make more than $137,000 on a W-2, that 12.4% tax effectively is limited at that point. This is where, Tim, I don't feel like I fully understand Biden's position. There's indication that he wants to eliminate that wage base for individuals that make more than $400,000. Does that mean that there's a bubble effectively of individuals not having to pay FICA and Medicare between, 137 and 400? Or I don't know. How are you finding yourself interpreting this?
Well, again, if your analogy back to the Obama administration is correct, back then, Obama introduced a surtax that, okay, you would cap out on the amount of Medicare tax you paid once your salary reached the threshold, but once your total income exceeded an amount, it was reintroduced as an additional 3%. And ironically enough, that's still on the books. Higher earners are still paying that surtax, as it were. And I would guess that this would mimic that.
So do you see this being, I agree with you that I think probably the application is going to be something similar to that. Would you say that where we've called this additional tax and Medicare surtax, additional Medicare that's paid by wealthy individuals, is this going to be like the Social Security surtax where another 12.4 is going to be tagged on, or at least their share of that 12.4?
Or maybe we pay the Obama surtax and the Biden surtax.
Oh, that makes sense, right? That'd be a little bit easier rolling off the tongue. Social Security surtax is a lot of S's. I don't know if I can handle that. Corporate tax rates right now are at 21%. Biden suggested moving that to 28% with an additional minimum tax on businesses that profit over $100 million. This is a common thing that was discussed during early debates amongst the Democratic candidates as well, an additional surtax on wealthy corporations. QBI deduction, Tim, this has been the thing I've been most nervous about because it's been such a huge part of our tax planning for the last 2 years, is this QBI deduction. That is the 20% additional deduction that business owners can get on their business income. An example being a sole proprietor, an S-Corp owner, an LLC. They generate $100,000 of taxable income. They could receive up to a $20,000 additional deduction by virtue of this tax law. Now, in the past, there's been business owners this has been a massive part of their tax plan. For health professionals, it's always been trying to target an amount that allows them to benefit from this tax law. Biden's conversation has been about QBI deduction for taxpayers, allowing it for taxpayers that make less than that $400,000 amount. So really targeting small business owners and defining a small business owner for the first time as an individual that makes less than $400,000. In the past, I'm trying to think of it, Tim, but I think small business owners have been defined by the number of employees that they have, by their gross revenue, and that gross revenue at times has been a rather large number. This is the first time we're seeing a small business owner being defined by the amount of taxable income that they have.
On their individual return.
On their individual income tax return. So setting a precedence that I'm wondering whether or not it will have a ripple effect into other ways that we define small business owners for the tax law.
No, it could be huge. I mean, the introduction of Section 199A, this qualified business deduction, really changed a lot of the ways we do tax planning. For the last 2 years, we've been trying to get people the right amount of salary deduction in their businesses so that we can maximize this. Now with this idea and the PPP loans idea, we're really going to have to do a juggling act before year end to dial this in.
We will. It doesn't leave a lot of time really post-election to try to sort out what to do there, but certainly would need to be done. If I'm a business owner, knowing that this is going to be the last year I can enjoy that QBI deduction, I'm going to be heavily motivated to accelerate certain deductions into the current year if I'm a cash basis taxpayer, perhaps invest in equipment that I was planning on doing so in maybe first or second quarter of 2021. I'm going to be motivated to try to get that deduction this year because it's a non-recurring element.
That's right.
A lot of conversation oftentimes happens around depreciation saying, well, if you don't get the benefit this year, you'll get it next year. QBI has been a unique element saying that if you're a specified service trade, if you're a medical professional, for example, it isn't like that. If you don't wisely use that depreciation in certain years, you can miss out on benefits that will not recur, that you will not get in the future.
It's not a timing question.
It's a strategy issue, which really I think drives home the point why tax planning is so important. Energy tax incentives. I've seen both candidates be, I think, supportive of green energy initiatives and trying to build credits around those. Trump has reduced the benefits associated with electric vehicles in the past. With Biden, you're seeing a restoration of that vehicle credit, as well as incentivizing individuals, both residentially and commercially, to invest in green energy by way of additional deductions and credits.
So are you saying buy Tesla stock or not?
I'm saying on November 5th, you may want to invest in Tesla stock. Man, that's an interesting thought. That'll be an interesting thing to watch, what the green energy market does surrounding this election. Because really it would be status quo in the event that Trump were to remain in office. But Biden's, I can see people being heavily incentivized to invest. So we don't give financial investment advice. I would certainly be interested in that, though.
And if I invest in it, that'll be a kiss of death.
Yes. So don't take investment advice from Tim. Healthcare, man, a massive point of conversation during the debates. What I want people to do listening today to kind of delve into what the tax ramifications are surrounding all the conversations about ACA, whether or not it's unconstitutional, conversations about strengthening it, what it all really means. And from my perspective, Tim, ACA was as much a tax initiative as it was a healthcare initiative. It was funded by additional surtaxes, by mandates from the federal government that they have to have insurance, effectively flooding the market with healthy individuals, changing kind of that risk gap to allow individuals to have those with pre-existing conditions to enter the insurance market more reasonably. It was a tax initiative, with the penalties on those credits and everything like that. I'm seeing with Biden wanting to strengthen the ACA, a return to kind of that mentality of saying, okay, we're going to allow individuals that historically have not received these subsidies because of their income to receive subsidies. We're going to encourage healthy individuals to come back to the market. I have heard zero conversation about reintroducing the individual mandate, though. Have you seen anything on that?
No, I haven't. But you're right. He is proposing to enlarge that window to encourage more people to go to the insurance marketplaces.
Making it more affordable, encouraging, again, just healthy individuals to do that. No conversation about reintroducing the individual mandate. Whether or not that happens, I don't know, but I am curious to see how that would play out.
And just the refresher, up until 2 years ago, all individuals were required to have health insurance that were making a minimal amount of income, or else they would be penalized on their taxes. That was overturned 2 years ago. But yeah, whether it comes back or not, that's a good question.
Yeah. One of the rattlesnakes that I've struggled kind of helping my clients plan around is those individuals that go to a health insurance broker, they buy health insurance on the market only to find out that they have to repay a lot of the subsidy when they file their income tax returns. There's probably a few listeners today that have experienced that, where they receive subsidized health insurance only to have to repay the entirety of that benefit when they file. Something that Biden has mentioned here is a increase, in other words, a lessening, I guess, of that effect for people that make more money, going out to the exchange, procuring that credit, but not so aggressively having to pay it back by way of eliminating that 400% income cap on eligibility. Certainly, he's going to have some eligibility cap on this. I just don't know what that's really going to be at this point.
It's a good point.
So, Trump has mentioned in all of his narrative that he always intends to reform tax law. He talked about modifying via executive order the capital gains rate from 20 down to 15%. I don't know really what that means. It hasn't been well articulated what he means by further income tax reform. Is there any one particular thing that you've heard of that comes to mind?
No, and I think until I see a bill, I'm hesitant. There's a lot of talk.
Yeah, certainly. Now, with everything that happened, Tim, there was a lot of tax legislation. I counted it up. We had to learn 9 new acronyms after this round of legislation that we've undergone. There's been a lot. We did a webinar about this a few months ago, where we talked about the stimulus checks, all of the tax incentives, the payroll initiatives as well. I want to lightly touch on those right now, but we'll ask Brooke just to send out a link to our prior webinar where we talked about that. I'd rather spend more of our time talking about some active tax planning strategies as well. But all the same, let's lightly touch on a few of these.
Agreed.
Stimulus check, I think most of the taxpayers that qualified have received that benefit. Talking to you about this earlier this morning, you and I both have some clients that have not received their stimulus payments though. A couple things they could do. They could go on to the IRS website and request it there. If they've done that, they could make a phone call as well. What are some of your thoughts of things that taxpayers can do?
Well, this has been an area that's major. It's misunderstood in a large way. I think after it was introduced, Congress told everybody that this is really an advance payment of a 2020 income tax credit. So on the 2020 income tax return that's filed, we will indicate whether we have or haven't received the stimulus payment. Those that haven't will be able to claim the credit for that amount against their 2020 income taxes. If their tax is zero, they're going to get a refund. So those that haven't received the payment yet have a choice to make. Are we close enough to the date when they expect to file their income tax return? They'll just take care of it then. Or should they try and get through to the IRS at this point and see if they can't get a check mailed to them before then?
A big planning item because it's based really on taxable income. Is that fair to say?
Yes.
So if 2020 is a banner year for them, expecting a lot of taxable income, 2019 was not. I don't know, maybe make a phone call, right?
Exactly. Or extend filing your 2020 taxes until you can get that secured.
I like that. So
there's also the issue of, we've been talking about for months, of children. Heading into this, we know that adults were able to get $1,800 each, whereas children got $500. I would tell people if they have a child that has a job that they could show is somewhat independent, maybe that child claims themselves on a personal tax return and claims $1,800 instead of $500.
Right. Definitely some planning there to do. I think in instances where they otherwise wouldn't qualify for the stimulus payment, it almost feels like a no-brainer, right?
Right.
Retirement plans. So you and I discussed a couple months ago the ability for individuals to take $100,000 out of their retirement plan without a penalty. There is expectation that they will repay, that they'll have to recognize it as income over the next 3 years, but definitely an advantage that otherwise they would not have to take out of a pre-tax retirement plan, penalty-free, $100,000 to deploy to address current needs. Now, I'm remembering our conversation that we had back then about what constitutes, I guess, valid need to take that withdrawal from your retirement plan. The language that they furthered is that it's one who's been diagnosed with COVID, one whose spouse or dependent has been diagnosed, or one who has experienced adverse financial consequences from being quarantined, furloughed, or laid off, or who has had his or her work hours reduced, or who is unable to work due to a lack of childcare. I think the one that I want to focus the most on is the statement that says, or who has had his or her work hours reduced. There are some business owners, Tim, that have weathered this very well, that have had unexpected success within their business during this time frame. However, there was a time frame where their hours were reduced, where they could not work. I'm not challenging the fact that they were able to rebound and do so very successfully. Is there an argument perhaps to be made that everyone perhaps meets this parameter?
I would say that it would be hard to see this as an area of abuse for the IRS. If people are going to rightfully pay income tax on it and report it, I don't see it as a major area to focus on. Certainly everybody should have documentation for taking a deduction. But I think they opened up the door with that statement to say, pretty much everybody's been affected by this,
right,
one way or another.
A lot of these feel like quantitative things, but there certainly is a qualitative element to that statement saying, have you been adversely impacted? Were your work hours reduced? You're right. It's probably not an area where I see a lot of, objective arguments being made.
Tell me what you think about this idea. If someone expects to have less taxable income to report for 2020, and they felt like they have been impacted by the COVID, Would it make sense for them to take money out of a retirement plan and reinvest it in a Roth?
Because you're avoiding effectively that 10% penalty in doing that, right? It's a good question. I thought about it. Our conversation we had 3 months ago was whether or not use of those funds, whether that was a disqualifying event, because effectively putting it into a Roth is saying, yeah, I was adversely financially impacted, but I didn't use those funds to address that adverse need that I had. The answer is I don't know the answer to that question, but as time goes on and I spend more time understanding, or I guess becoming more comfortable with what's been said, it may be a valid strategy. It might be. I don't know at this point, though. Charitable contributions. Modification there as a reminder to everyone is that everyone can take an above the line $300 deduction there for charitable contributions that they make to qualifying institutions. It's not a huge benefit, but it's something.
Well, and as a reminder, I mean, the tax reform of 2017 doubled the standard deduction. So the projection was that there are 30 million Americans that no longer qualify to itemize.
That's right.
So that made charitable contributions less important to the general public than they had been.
Absolutely. We're going to talk about it a little bit later, but let's readdress this when we talk about our SKIP methodology. I think that's what you and I call it, but that methodology with charitable contributions. But you're right. Those that weren't incentivized really to pay in the past, at least are incentivized to the tune of about $300.
And I'm going to circle back to this when we talk about the state credit.
Good. That'd be great. 100% though of charitable contributions on our AGI limitation. So historically, if your adjusted gross income was $100,000, you could only really deduct $50,000 of charitable contributions in the past, $60,000 in certain instances. This is a year where every dime you make, you can give to charity and not pay tax.
Yeah, pick your tax.
That's right. Now, with very limited application, this might be an area of interpretation for certain taxpayers.
Exactly.
Student loan repayment. Tim, to be honest with you, you're probably much stronger in this realm than I am. The more I've learned about this incentive that they put out there, the more complex it seems than just having employees, divert $5,200 towards student loan repayment.
This honestly was one of the big disappointments of the summer for me. This came out and I thought we could do a lot of things with this, but as we got into the rules and requirements, if you want to offer a student loan repayment for an employee, it needs to be part of a written plan that your business has. And it cannot be, again, you can't divert the funds to highly compensated employees or their family members. And you can't give an employee an option of taking the cash or the student loan payoff. But scenarios I do think of is in this tightened job market, where people are struggling to get employees, maybe you use it as a recruiting tool. Maybe you say, you know what, if, all of our new hires will pay off $6,000 of their student loans.
I like that. So great option for those that are looking to hire and incentivize quality talent. A bit more difficult to apply as it relates to an existing workforce. Is that fair to say?
Yeah.
Okay.
And it's a bit harder to pick and choose.
Absolutely. Other things that have happened here that, again, we discussed previously, the payroll tax deferral, the ability of a business owner to defer payment of certain payroll taxes and pay them in subsequent years. Payroll tax credit refunds. So I'm thinking here of FMLA, FFCRA, the business owners that have paid the wages of individuals that were adversely impacted by COVID and the credit that they can claim on that on Form 7200. All complex issues. Again, revisit our previous webinar on that. The employee retention credit, though, is probably one we should spend a little bit of time with.
And I will say that the payroll tax deferral has come out in the intervening months since our last broadcast. And, it came by way of executive order, but we're finding that it doesn't have a lot of applicability because most people that I'm working with are hesitant to defer paying their payroll taxes simply because they don't want to be stuck with a bill in January, that bought them some time in the fourth quarter.
I think COVID has reset a lot of risk expectations for business owners. Less are willing to speculate on what the future will hold, what their financial well-being is going to be in the future. So a lot of these defer initiatives just aren't attractive. I think that what they want to say is, I can address it now. I don't want to run the risk of not being able to address it in the future.
Exactly.
So really the applicability is for individuals that are unable to address it, financially incapable of doing it, with the hope that they will be able to in the future. Is that fair?
Yeah.
This employee retention credit is an attractive one. I want to just maybe touch on some of the basics here. This is for business owners that maintained a workforce when really they had really no economic reason to do so, but did so anyway. So that's individuals that were shut down by government order, which many were, those that experienced a substantial reduction in their gross receipts due to COVID as well, things of that nature. And so I think a lot of business owners are saying, hey, I heard about this great $5,000 credit I can get for retaining a workforce during a difficult time frame. Question number one is, did your revenue reduce by over 50% over the previous quarter in 2019? It's kind of a big question. Now, these are or questions, don't get me wrong. They're not and questions, but it's a good place to start. Did that happen? No? Okay, well, the next question is, were you suspended? Yeah, you were during that time frame. Okay, that's great. The big question that isn't a listed bullet point here has to do with PPP. Can you maybe enlighten us a little bit there about PPP?
Well, the IRS has said on their website that if a business has taken a PPP loan, they are ineligible to take this credit.
Now, I think you're going to see some business owners that are speculating to some extent on whether or not that's going to be modified or changed with future legislation. But as it presently is constituted, a credit really is. I recall during our previous webinars, we were talking about the federal government putting in place all of these benefits and initiatives for business owners. They were not designed to be compounding. They were designed to be effectively redundancies in place in the event that you didn't get one of the other benefits. You don't get PPP, great. Well, there's these employee retention credits. You don't get those, great. Well, there's FMLA benefits here as well. You don't get those, well, you can defer your payroll tax, right? They were never designed to be compounded on top of one another. Is that fair to say?
That is.
So we just need to kind of keep that in mind. I'm not discouraging individuals from, making what decisions they deem appropriate, but just bear in mind, as it's presently constituted, it's hard to make these things stack on top of each other.
And I would guess that since the deadline for applying for PPP has closed, maybe there are businesses that didn't get the PPP that are now suffering that would be eligible.
This would be a great fit for them. Great way for them to kind of replicate that benefit. Net operating losses, we discussed the ability for business owners to carry back their net operating losses from both current year, 2020 and 2018, 5 years back to consume other sources of income, generate big refunds. I've seen this applied actually a few of my clients. It's been very beneficial, been a lucrative thing to consider, and really in limited instances.
So look back to 2015.
Really back to 2013 almost, wouldn't you say?
Yeah, from the time it was it was put in place.
Good luck finding that many years of income tax returns, but I mean, looking back that far would be meaningful.
Well, I'm thinking potato farmers probably don't have anything pleasant to look back to, or dairy producers for that matter, but maybe there's that pocket of people that made big money back then.
I'm thinking of maybe some of your real estate developers. I'm thinking of those involved in manufacturing. I mean, they've had some boom years in this time frame.
And this is still reaching back to those highest tax bracket years.
It is. Even Obama era brackets as well.
Exactly. If you can reach some of that 39.6 money and get it back today, well worth consideration.
Agreed. Now, I mean, this is, again, why tax planning is so important, because the generation of a net operating loss is a complicated thing and oftentimes is very inefficient from a tax perspective, right? And so the decision to make a net operating loss and carry it back, sure, one may be imposed on you, but there are certain instances where you can make a net operating loss by way of depreciation and other things like that.
Exactly.
It's really something that really depends on a variety of factors. The QBI deduction, the lowest income tax rates compared to the highest one that you're offsetting, really, and what also you expect to have happen in the future as well. A lot of factors to consider there. Qualified improvement property, Tim, I put this on here really just to mention that, in the debates, it's been mentioned the desire to repeal Trump era tax reform. This was an element of Trump era tax reform that I think individuals should be aware of. Trump era tax reform widened the amount of, I guess, qualified improvements that are made to businesses that actually qualify for bonus depreciation, accelerated write-offs. It's a big deal. And, you know, if you're renovating a new space or you're owner occupying a business that you run, and you are planning or counting on renovations that you're placing in service in 2021 to be a big tax write-off in that year, that may be compromised here at this point. We don't know really, but I mean, if Trump era tax reform is what's being attacked, then this is a provision that may change.
You know, and I'm going to say that all things real estate take a spotlight in this tax discussion this year. The fact that the country has runaway inflation as it relates to real estate has changed a lot of strategies for people. And one of those is, you know what, it's cheaper to remodel than to build right now.
Mm-hmm.
So if there's a way to reduce the cost of that remodel by getting some accelerated depreciation, this becomes a big deal.
Absolutely. You know, let's highlight a couple of those just for real estate on the cusp of potential tax reform here. Capital gain rate is one I'm thinking of. Like-kind exchange, whether or not there's going to be any further reform there. No indication really, but there might be. Top tax rates, qualified improvement property and the related depreciation. And also the notion that if you're repealing Trump-era taxes, does that mean a repeal of the 100% bonus depreciation as well for new and used property? Because that was a provision that came out 3 years ago. That certainly has its ramifications on real estate developers.
It really does.
So let's talk about PPP. The truth is, this might be the only reason why we have some listeners today. So they want to know what's going on with PPP. We have gridlock right now between the House and the Senate, right? I mean, they were cooperative with one another back in March when we were passing CARES Act. It's great. This CARES 2.0 that we've been trying to pass has been met with opposition on both ends. You have the Republicans looking to spend only $1 trillion. The Democrats wanting to spend about another $3 trillion, having a hard time meeting a middle ground, right? What's been locked in all of this, though, is the mutual bipartisan desire to make this PPP program easier to get through, right? There's been talk about, hey, if you got 150 or less, you won't have to apply even, but we've been locked up. So what does the SBA do? They come out and talk to us themselves. What are some of the things you've seen the SBA talk to us about?
Well, I will preface that by my comment by saying that up until a week ago, 2 weeks ago, people had been submitting applications for forgiveness of their PPP loans and just, you know, without any response. But it was discovered that up until 2 weeks ago, they hadn't responded to one.
None of them have been even accepted or processed.
But once it was revealed to the public, they agreed, and now they're starting to forgive or act on some of the applications. But pressure is building. I mean, especially at the SBA, they're waiting for guidance from Congress on how to respond to some of these unanswered questions. But at the same time, the public is coming up against certain deadlines. So again, last week they came out with clarification. When someone's first repayment is due, if they take the day they receive their PPP money, they add 24 weeks to that. That's their measurement period to spend their money. And then if you add 10 months to that date, that's when their first payment should be due. Now, certainly everybody should contact their lender to see what their own bank's policies are going to be for repayment
we've seen
of
some
those.
inconsistency there, haven't we?
There is a lot of misunderstanding out there as to, you know, my loan document says one thing, but the Treasury has said another.
Absolutely. So let's outline the things we know definitively from SBA in the last couple of weeks. Definitively, we know that they've simplified a loan forgiveness application for those that had an amount of less than $50,000 in PPP proceeds.
We now have 3 forgiveness loan applications.
3 different types.
We have the 3805S, the 3805EZ, and then the 3805.
Got it. Truthfully, I mean, do you find the 3805EZ really that much simpler than the others?
It comes down to documentation.
And at the end of the day, they're requesting about the same amount of documentation. So sure, there's a simplified form. You're filling out fewer boxes, but there is a form out there. We know that They're trying to ease that burden. The SBA, I think, agrees with the bipartisan efforts to simplify this process. Certainly not in their power to say who can and cannot apply for forgiveness, but they can try to simplify the process. We know that they began approving applications, like you said, as of October 2nd. So this has not been something they've been actively doing for several weeks or months even, which I think has been the misunderstanding. Another big thing that you've clarified here for us too is that on a lot of these forms, it said at the top something along the lines of, application expires October 31st. And that was really just that the form was due to be revised at that time. But it created in a lot of people's mind anxiety saying, man, do I have to apply for forgiveness in the next 2 weeks? And the answer is no. The SBA has clarified that you have, up to 10 months after the last day of your measurement period. So you gave a wonderful example. I tried to articulate one here. The borrower's cover period ended October 30th, 2019. That means that they have all the way until August 30th of 2021 to effectively apply for forgiveness before their first payment is due. So they have 10 months. They have a lot of time right now. Elephant in the room, though. You have 10 months to apply. What's the hurry? Why would you want to apply for forgiveness?
Well, so my answer to that is another question. Do you think a person could really file their 2020 tax return not knowing whether that loan was forgiven?
Based on the current law, no way. There's no way they could file their income tax return without knowing whether or not that is forgiven.
Okay, tell us why.
Reason being is that right now, when these PPP programs were put together, the narrative I think that was heard through the news circuit is that they're receiving this tax-free benefit, this grant that will help them recover and keep people employed and just keep going. The fine print of all of this, though, was that the amount that you use, the proceeds that you use, the PPP proceeds, if you deploy that towards payroll, towards utilities, qualified expenditures, that's great. You've secured forgiveness, but those expenditures are now non-deductible. So that means that the effect of the PPP proceed is that it's taxable.
It's raising your taxable income.
It rose your taxable income. So how can you go into this knowing whether or not it's a loan that is not taxable income but must be repaid, or if it's taxable income that you've been forgiven of? Now, it's my expectation that we're going to see some narrative that alleviates that. I don't think this is what anyone was expecting. I mean, I think we saw in the fine print, certainly that's what was happening, that the effect of it being non-deductible means that it's taxable. But is it your expectation that we're going to see some legislation that changes that?
Again, I think pressure is building. Something is going to have to happen.
Yeah.
And to add to that, this 199A deduction that we've talked about will compound it. So if my PPP loan forgiveness eliminates the opportunity for me to deduct the wages that I used it for, it also reduces my 199A deduction.
And if you're a medical professional, it pushes you beyond even your ability to use the QBI deduction too. It has a terrible impact if it's taxable.
We've even run scenarios along that line that show that some taxpayers would be better off repaying their PPP loan than asking for forgiveness. It's kind of mind-blowing.
It is mind-blowing.
That you would be better off economically
paying it back. It's mind-blowing. It is. It's my hope that we won't have to so aggressively plan around this PPP money, because right now on the few tax plans I've done so far this year, there's 3 columns. There's last year, this year what we're planning for, and this year plus PPP, because we just don't know. And in that lack of clarification, how do you accurately plan absent knowing that, so.
Yeah, in a nutshell, our advice to people is don't be in a hurry to apply for forgiveness.
I think that's fair. But also know that guidance can change on a dime, because post-election, we may find that the gridlock that the House and the Senate's been locked in will suddenly be released, hopefully, and we get a lot more clarification on what CARES 2.0 means and what it means to have received a PPP loan. So,
good point.
All right, HHS update. This is for our medical professionals that are listening real quick. They received several months ago a subsidy.
Friday, they're probably still on the golf course.
That's true. They're probably not listening, so I'm going to have to make some phone calls after this webinar. What we're looking at here is that several months ago they received a subsidy from HHS that provided them a 2% on effectively gross revenue, qualified gross patient care revenue. That amount was met with a second round of HHS proceeds for really dental and oral professionals that could receive this, but they had to apply for it. They received that benefit. We are now on round 3 already of HHS money. Now, there's not going to be an immediate initiation of this money, but the language is that if you've already received 2% on your gross revenue and you've already applied for it and received money, you may still benefit from applying again. So it's our recommendation that if you are a medical professional, you've received the money, or you haven't, goodness, if you haven't received it, please apply. But if you have received proceeds, do it again.
Do you have to be a Medicaid provider?
No. The initial guidance on that was yes. Okay, the initial amount on that was yes. What I learned on round 2 of this with medical professional or dental professionals is that they were still providing benefits absent that requirement having been met. So the answer is this is one of those Velcro wall strategies where it's like, just throw it at it and see if it sticks.
And I don't think it's a complicated application.
It's not. It's pretty straightforward. You provide some pretty easy information. Round 3 is going to ask you questions about 2020 because round 3 is about 2020 harm. They're trying to benefit medical professionals that have received some harm and provide a subsidy there. But that all being said, we thought it was only for Medicaid and Medicare providers initially, and it wasn't. So,
strings attached?
Well, at this point, I think we're looking at a need for them to demonstrate use of those funds. The language initially on round 1 was, hey, this is for COVID relief on round 1. Round 2 strengthened that language by saying specifically what they wanted it to spend it on. Kind of payroll, COVID aid, supplies. They're wanting a demonstration of that. This third round, I think, is going to be, documentation standards going to be much higher.
Okay.
What do you think?
No, I would say that if a provider has expenses to the extent of this third round of money that they've received, they're going to be in a good spot.
Good. We have until November 6th to apply for that. So listeners don't know, this is kind of our Christmas for us right now. It's October 16th. It's the day after our deadline. We're feeling pretty good right now. I think Tim's going to be ready to roll on Monday to help you all fill out those applications. So just give Tim a quick call. Just kidding. I'll help Tim. So. All right. We've talked about what's taxable and what's not taxable. Tim, walk us through this list and what we know, what we don't know, and what we think might happen.
Okay. So I think in February, everybody was dancing in the streets saying, we're getting free money. Free money from the government, make it rain. What we're finding is, okay, some of this is going to be taxable. Let's start off with the EIDL loans. That's a traditional vehicle the SBA has used to help people in disaster situations. For purposes of COVID, they said you can still apply for those loans, but you can also get an advance grant. So our listeners know there's a difference between an EIDL and an EIDL grant. The EIDL grants were just $10,000 amounts that were paid out to businesses that were affected by COVID. Those $10,000 amounts will be tax-free grants. So, and of course, if it's an EIDL, it's a loan that's treated like a loan any other case.
Can I ask a question about that?
Sure.
I know the language changed a lot throughout those, as time went on, but there was conversation that the $10,000 EIDL grant served to reduce your forgivable portion of your PPP money that you had as well. Any thoughts on how that interplays with the forgivability, given that it's tax-free, but we also know that it was designed to reduce the forgivable portion of PPP?
I don't. You probably know the answer.
I don't. That's why I was asking. Normally I ask you baiting questions that I know the answer to. This is one that I just don't know if we have the clarification on quite yet.
Well, and if someone has a PPP loan less than $50,000, we know that the language that just came out on that last week said it can't be reduced,
Yeah.
period.
Yeah.
So if someone got 50,000 PPP money, plus they got a $10,000 EIDL grant, that's the sweet spot.
Yeah. Unique situation. I mean, I don't know. Non-taxable, certainly. My concern is what interplay does that have with the forgivable nature of the PPP at this point, given that they've drawn a distinction between one being taxable and the other not. So,
Good point. All right, let's talk about the physicians' payments from the Provider Relief Fund, or this HHS money. And we call it HHS because when it direct deposits into your bank account, that's the identification that comes with it. That will be taxable money. The SBA determined, or the IRS determined, that that would be in the category of taxable.
right. I found that most recipients were understanding of that. So I think that, I hope that's well understood.
Okay.
Yeah.
Then we have the farm money, CFAP, that was paid out to producers, agricultural producers. We don't have anything definitive on that yet. The IRS has not ruled. I know in the past, in working with the USDA grants, some of them have been taxable and some of them haven't. The inclination right now is that it most likely will be taxable. So we're doing our planning for ag producers around that position.
Being taxable.
The Idaho Rebound Grant. These tax programs administered by the states are generally taxable.
Do you think we'll see maybe from Idaho a 39R subtraction for that or something like that down? In other words, do you think Idaho may remove it from their taxable income? Federal, I agree with you. I think it's going to be taxable
I think there's certainly going to be pressure on the Idaho legislature to come up with something
along those lines.
Especially as it's been broadcast that Idaho is now having a windfall year for tax revenues. It would be an easy fix.
Yeah. Okay. Final one, the payroll tax subsidies. So, the retention credits and things of that nature. Thoughts on that?
My gut tells me that that is going to be taxable in the sense that you cannot deduct the payroll that the government paid on your behalf.
Agreed. It's not uncommon, though, for the federal government to add back what benefit you get as a credit back to your taxable income. Research credit does that. A lot of employment-related credits do that as well. So if you get the credit, great, you reduced your taxable income, but they're going to add to your taxable income that same amount. So I think it's going to play like that.
I think that's true. Let's talk about a couple other things. So that stimulus money people got, I think we already said that it's really been defined as an advance credit
right
on your 2020 taxes. So on your 2020 return, there will be a question to say, did you get your money already?
Mm-hmm.
If so, ignore this line. If not, go ahead and claim your credit now.
Right. So effectively meaning that your stimulus money is not taxable. It's a credit that you're just entitled to. So.
And then unemployment benefits. A lot of people have filed for unemployment this year. They will get a W-2 for that.
All
and
taxable.
Will be taxable.
Yep. Okay. I'm going to do my best to not make this part boring, okay? It's important, though, for its predictive elements here. There's something predictive about this that I think people need to look into. Look past all of the rhetoric. Look past all of the mean things that are being said on Capitol Hill. Look at what's happening, okay? We have a CARES Act that was $2.2 trillion, okay? It was a very lucrative, meaningful piece of legislation that received bipartisan support, okay? The second round, I think it's agreed by both parties that they want to do something more for American business owners and taxpayers. Round one was introduced by the Democrats. It was known as the HEROES Act back in May. It was a $3 trillion initiative, okay, that was not met well by Senate Republicans that felt like we needed to spend less money. Didn't make its way past the Senate. Senate at that point then introduced their plan, what they're calling the HEALS Act. Adorable acronyms across the board, by the way. July 27th, a $1 trillion plan. So the Democrats responded by issuing a couple weeks ago their 2.0 plan, HEROES 2.0, that is $2.2 trillion, kind of middle ground between the two of them. One was 3, theirs was 1. They're meeting at about 2 right now. Now, they're gridlocked up for reasons that are probably outside the merits of the law itself, but I'm thinking that this Heroes 2.0 might be something that would be worth getting used to. What are your thoughts?
I agree. The president and the Senate are so far apart on their proposals that I think the Republicans have the high ground on this. I mean, the representatives have the high ground on this. They'll be able to defend and probably get their way on most of it.
Got it. So that being the case, let's just maybe familiarize ourselves a little bit with Heroes 2.0. It won't take too long. Included in that is stimulus check payment amounts. So I think we'd be looking at a second round of stimulus check payments going out, maybe a widening on who actually gets those checks as opposed to the very limited number of people that got them on this last round. Dependents getting $500, similar to the last one as well, with no age limit on this one. Unemployment benefits remain enhanced. That's $600 per week. Unemployment going all the way until January of 31st of 2021. We're sitting in kind of this expired situation right now where the executive order has kind of filled that gap on unemployment benefits, but this being passed would enrich that again.
Would they double the number of dead taxpayers that get their stimulus money?
Maybe. There's days I wonder if you're at home wearing a tinfoil hat, There's days I wonder if you're just... The PPP, we'd see, I think, more money being allocated to that, another round of that going through, probably being far more artful about who would receive those funds, more demonstration of harm, probably things like that is my guess. Maybe just specific industries really benefiting from that. Employee tax credits, being enhanced as well for those that did not get PPP funds, maybe on the second round, being able to participate in this enhanced employee retention credit. Eviction subsidies as well, school reopening monies being paid out to schools, and money being allocated towards coronavirus testing as well. So probably something, I think some form of that being passed at some point. What I have not mentioned here is what they plan to do with the PPP loans too, and planning on alleviating the need for individuals to apply for forgiveness if they have less than $150,000. We don't know yet, but it's my hope that we see something like that pass. Okay, Tim, when you sit down with a client to do income tax planning, what's in your mind? What do you want to target, I guess?
Well, number one is no surprises.
I agree.
Accountants hate surprises.
Mm-hmm.
To that end, we try and develop a strategy that's long-term vision, forward thinking.
Mm-hmm.
It seems like you mentioned before, so many things are timing issues that you ultimately have to pay the piper at some time.
Mm-hmm.
But if there's a way to effectively enact or come to create a tax strategy that allows you to pay an appropriate amount of tax over time, the minimal amount,
Mm-hmm.
Without going through huge cycles of up and down.
Agreed. So something that's like sustainable, something that's consistent, something that could be understood, no surprises. I mean, that's a big deal, big reason why we do tax planning. Structuring around QBI deduction, like you've said, those things that are not repeating, absolutely, and being sensitive to credits that can phase out. What I'd like to do then with the remainder of our time is talk about some of our favorite tax planning strategies that are coming up this year. Now, there's far more that need to be discussed individually with each taxpayer, each client, and the member of Cooper Norman. But Cooper Norman is extremely well equipped at this point to help clients tax plan very effectively this year. If you haven't done it before, man, what a great year to do it for the first time. And if you've made a habit of doing it, you'll know the value of sitting down and going through each of these things. Whenever I sit down, Tim, just like you said, I like looking at the effective income tax rates, saying, okay, what is your taxable income last year? What are we looking at this year? And what variables do we have in our hands to hit a very meaningful, effective marginal tax rate? When I look at this, you'll notice that the jumps in the tax rates are mostly nominal, kind of just incremental, but there are a couple that jump pretty hard. One is the 12 to 22, and the other is the 24 to the 32. Those are big jumps. And so if at all possible, I love keeping my clients either at $80,000, at $80,000 if possible, keeping them in that 12% bracket as long as possible, or keeping them beneath 326. If I'm in that range, I know that we're tax planning well. Their overall effective rate's going to be 18 to 20%. It's a good outcome.
Well, and we've got a multiplier in the mix there with that qualified business income deduction, especially if a taxpayer is in one of those specialized services.
Right.
So suddenly, if we can get a physician or an attorney, if we can get them below that 326, then suddenly they're getting double benefit. Right. And it's an exponential. It's not just the 10% tax change. It's 10% plus 20% of their taxable income. We could, effectively see that. And what a year we've got. If you could do that by your charitable contributions.
Right. Speaking of those attorneys and those medical professionals, you and I ran a scenario once that I've never forgotten, where we said, okay, taxpayers' federal rate is 24% right here. But if this taxpayer pushes themselves further into the 24% bracket and misses out on this QBI deduction, their effective rate during that stretch is 60%. I remember that conversation. I'll never forget that. That there are just nuances in the tax law that if you miss out on the QBI and managing a bracket like that, sure, it says 24%, but if missing out on a benefit means that your taxable income goes up by that much more, your effective rate could be 60%.
Exactly. And I feel like the government more than ever has just enlarged our toolbox with the options we have.
Agreed. Depreciation, let's not spend too much time here, but that's probably one of the first things that we talk about with business owners when we're doing income tax planning. What equipment has been acquired? What equipment does your business need? Clients that know me best know that I use the tail wagging the dog. I never want to be the reason why a business owner buys a piece of equipment. That's bad tax advice. That's bad financial advising, quite honestly. But if a acquisition of an asset is planned within a 3-quarter period, saying that you can either get it Q4 of 2020 or Q1 or Q2 of 2021, but your business has need of it, discuss that asset. You know what I mean? No harm in accelerating the acquisition of that asset if it means that you're hitting a meaningful tax outcome.
And I'm thinking of, experts have said in the next decade, we're going to see the transfer of more businesses than at any other time in the Earth's history because of the baby boomers that are retiring. And I think this comes into play when you're considering the purchase of a business. If you could allocate more to depreciable assets, suddenly you're reducing the effective cost of that business. And so definitely, as people consider investing or buying, if you could get the faster write-offs of some of this stuff that's available today, go for it.
Agreed. So as a reminder to everyone, Section 179 and bonus depreciation is your ability to write off an asset in the year of acquisition. So even though it may be a 5 or a 7, 15, even 20-year asset, these tax laws or the advantages allow you to write that off in the year of acquisition. I wrote in here class life and cost segregation because, for your more advanced taxpayer, a business owner that perhaps owns some real estate as well, perhaps even occupies a space that they own to operate their business. I'm thinking of maybe a dental professional or an engineer, or they have their own warehouses, their own practicing space. Oftentimes when I look at income tax returns, for these individuals, when I'm meeting them for the first time, I'll notice that their building is being depreciated over 39 years, and they're missing out on an ability to accelerate the depreciation on the building that they occupy themselves. So a takeaway here, one of those 3 ideas, you said your goal was that people leave here with some ideas. If you're a business owner that owns the building that you operate out of, you need to talk about how that's being depreciated, because you may have great opportunity to accelerate the depreciation on that building.
That's a great point.
Add to that real estate professionals. If you're a real estate, you have real estate, you're spending over half of your time throughout the year engaged in those activities, talk about it. If you're actively involved, let's say you're doing maybe 500 hours a year in real estate, that's another conversation point as well. So depreciation is more than just writing off your equipment. There's depreciation benefits locked up in the real estate that you probably already own. So research and development credit. The only thing I like talking about is the research and development credit. Our friendship was built on this credit, Tim. The research and development credit's been around man, since Adam, quite honestly. I think it's been around since Reagan. It's received bipartisan support. Every president, every House, every Senate that's touched this credit has done nothing but enhance it. So it's going to be here to stay. This is a very unique credit, and that every other tax advantage I've seen kind of oscillate with who's in office. This one doesn't move. This one receives bipartisan support. So what it is it's a 6.5% credit effectively on every dollar that you spend in the realm of research and development. Now, what's dissuaded a lot of people from utilizing this credit in the past is that a lot of taxpayers have felt they need to be wearing a lab coat in order to get this credit. And really nothing could be further from the truth. Your clients probably more actively use it than any others in the realm of ag development and ag real estate. In ag, I mean, I see great application in that industry. Medical industry utilizes it. Manufacturing is huge with the research and development credit. Now, obviously, you need to be doing specific things to get the credit. And certain business owners say, you know, the juice isn't worth the squeeze. I really don't want to do that. I understand all of those sentiments. But really, if you are involved in improving your business by way of a scientific method, and what I mean by that is that you have a hypothesis, you test that hypothesis, and you come to a determination whether or not this is improving your business, you may be engaging in something that would qualify for the research and development credit. Now, bear in mind, a lot of people think, I do this all the time. I'm always trying to improve my client offering. I'm always trying to make something better. I respect that. The research and development credit is designed to focus on you relying on a physical science. So chemistry, physics, biology, computer sciences. It's looking on you relying on some physical science to reach a conclusion there. So,
and isn't it heavily weighted towards labor?
Absolutely. So, you know, there's no need for you to go out and contract research, you know, entities to engage in these kind of activities. It's really just saying, as a business, I'm engaged in these type of activities, and I already have a workforce that is engaging in these activities as it is right now. All I need to do is claim the credit.
I'm seeing a spectrum, just my own experience. You know, for years, I know you've been beating the drum saying this is an underutilized credit, and you've shown people how to do it the right way. I'm almost now starting to hear rumors of people that are blowing it out of proportion.
Right.
There are groups that are saying, you know, if you go to work every day, you should be.
I have heard these as well. You know, I'm going to speak bluntly about it. I've heard it a lot in the dental industry. I've heard a lot in the medical industry. You know, a lot of advisors that are, I'm making them sound nefarious, out-of-town advisors that are coming and saying, hey, we have this expertise in claiming this credit. I don't challenge their familiarity with the credit at all, but what's important is that those that procure this credit understand what they're asking and what they're claiming. Again, I'm not going to be in any position to challenge what they're doing one way or the other, but what is important is that the taxpayer understand, number one, how they're being charged for those services, and number two, that they understand the intent that the government had when they established this credit. I did my best to kind of try to make this as, I guess, benign as possible here, but qualifying types of activities are testing new products or materials. And by new, I mean kind of almost new to your industry, new to your methodology, okay? To say, hey, I was brushing my teeth with Colgate, now I'm doing Crest, I'm engaged in a research and development activity. That's not really what they're getting at there, right? Development of new or enhanced formulations. So pharmaceuticals is kind of what I think about when I think of that, or, you know, fertilizers or things like that, compounding of some sort of, you know, formula. Testing new concepts, improving existing products, trial and error experimentation. The one that I like the most is designing tools, jigs, molds, and dies. Those that are involved in manufacturing every year are building out new product offerings based on, you know, modifications, let's say, to other commercially available products that they have to retrofit to. Or, you know, let's say you manufacture boats or something like that, you know. Engaged in the development of those molds is a research and development activity.
I'm thinking of, you know, agricultural clients that are constantly modifying their equipment for the type of soil they farm.
Absolutely.
Or the elevation that they farm.
Absolutely. Developing or improving production or manufacturing processes, upgrading your systems and your software. This one's actually kind of a soft area in there. You know, a lot of people that are transitioning over to, new forms of software, maybe even having to contract someone to help code some of their own software, automatically qualify for this credit. So you'll see business owners hopping in and out in qualification of the business. Those that are most richly benefited by it are those that are on an ongoing basis engaged in the kind of activity that this describes.
So this should probably be visited on an annual basis?
It should. I mean, just, hey, what are you doing in your business? I can't, when I was in school, man, I'm sorry, you're gonna have to hear a story here. When I was in school, I sat in one of my tax classes, and on day one, he said, tell me, I want you to write down everything about yourself. Tell me everything about yourself. Tell me how many kids you have, your family. Tell me about what injuries you've had in the past. Tell me everything. And what I loved about that is that he says, okay, we're going to take Bill here. Bill has told us 90 things about himself. Let's build a tax strategy around him. I loved that conversation. And in fact, you may even remember we did that here at Cooper Norman once, where we brought all of our staff in and we said, okay, here's Dave. And Dave is in a wheelchair and he wants to go to a baseball game. He's a business owner. And we told this huge story and then said, tell us the tax strategy around this guy. Tax planning is the time to do that, right? And the research and development credit is going to be underutilized if you're not talking to your CPA about what you do. You really can't say to your CPA, hey, you should have known. It's like, well, you need to tell your CPA what you're doing, so they can identify opportunities for you. It helps. It needs to go both ways, I guess is what I'm trying to say. I've listed a bunch of non-qualifying activities. They can look through those. Qualifying expenditures, mostly labor-based. Absolutely, those are what I'd say. Documentation standard. This is one of those things where the case law around the R&D credit is massive. The actual code section around is very, very brief. It says, I've memorized it. It just says that the taxpayer will maintain documentation sufficient to establish use of the credit. That's all it says. And so that can be interpreted many, many different ways. We encourage people just to, dedicate resources to tracking this credit. So a lot of employment related credits. I've done a lot of talking here. We don't have to go too deep into these, really just saying, be aware of them, right? I mean, is there any, Tim, that stand out to you that you think are underutilized?
No, hopefully everybody is familiar with that form 7200. It gives opportunity for employers to claim some credits for people they paid who were at home because of COVID, and to claim those credits. I mean, everybody should be familiar with it. Work opportunity tax credit. Again, this is a payroll credit. If you're hiring people that are from disadvantaged sectors of the economy, and there are ways to ask those questions up front when you hire somebody without violating anybody's privacy. Certainly it's underutilized. You get a credit against your payroll taxes. The small employer health insurance credit. I've thought for a long time, well, this really applies to a small section of companies, but I'm finding that as it becomes more and more competitive to bring in employees at any business, benefits are becoming a big deal. So if you're a small employer and you don't have a high average salary for your company and you offer health insurance, certainly look into this. The government may be willing to help you pay for some of those insurance benefits.
I like that. The disabled access credit is one that I'm finding is coming into vogue a little bit. Oftentimes business owners are investing in equipment that is ADA compliant. They're making renovations and improvements to their space that they occupy to accommodate those that have need of those ADA compliant resources. It's a very lucrative credit. I mean, it's up to $5,000 a year that a business owner can get for investing in these types of improvements to their business or equipment that accommodates this. I'm thinking about maybe renovations to a bathroom or a front office space. I'm thinking of equipment that is certified as ADA compliant. I'm thinking of those types of things, I guess, Tim.
Yeah. The initial thought is, well, I mean, it's specialized equipment, right? But I mean, if anybody is making improvements to a building and you're widening a hallway, widening doorways, if you're putting in
rails,
or handicap compliant toilets, lower sinks, I mean, certainly those come into the conversation. Dental chairs that are accessible by someone in a wheelchair.
Mm-hmm.
It's really quite easy if you're putting in ramps.
That's right. They've enhanced this credit because in the past it was hard to get. They used to just have the floor saying that if you have $1 million in gross revenue, you can't take it. They changed it to say $1 million in gross revenue, or you had 30 or fewer full-time employees in the previous period. So a lot of medical professionals, this enhanced their ability to claim the credit.
So I guess a conversation to have right now is, did I do any improvements?
That's right. That's right. And if so, then be sure you're claiming the credit. That's $5,000 you otherwise would not be able to recoup.
Exactly.
A lot of state-specific credits and incentives. Tim, obviously you're very well versed in a lot of these. Let's begin by saying that we have clients throughout the nation. I mean, sure we have Idaho clients. We live here in Idaho, but each state's going to have its own conversation to have. And so, I mean, I want to talk about a couple Idaho ones, but bear in mind that this conversation during planning needs to be had based on each respective state in which the client lives. The ones that come to mind, the easy ones are Idaho investment tax credit. Really, if you're investing in equipment here in Idaho, you're going to claim the credit. Nothing wrong, though, in asking just to ensure that that's being claimed and being picked up. Idaho has wonderful education credits as well, too. You've outlined a scenario for me once that, we had talked through where a taxpayer donates $2,000 to a school. You want to walk me through that example?
This had more meaning back when we had 39.6 tax bracket, but
Right.
Certainly at 37, it's worthwhile. Idaho allows you to take a credit for 50% of money you donate to a school in Idaho, public or private, with a cap of a $2,000 deduction. So if a person who is itemizing were to deduct or were to contribute $2,000 to their child's elementary school, they would get $1,000 off their Idaho taxes, plus they would get an itemized deduction on their federal taxes if they're in the 37% tax bracket. That would reduce their out-of-pocket by $370, plus they would get the itemized deduction on their state return, 6%, another $60.
Right.
So out of pocket, your $2,000 contribution to the school, may cost you a couple $100. And given the current state of our schools, I would encourage everybody to do it.
Yeah.
If you're not going to itemize, at least consider giving the $300 above the line deduction that's available for 2020 and take the Idaho credit. And for the minimal amount out of pocket, it's going to end up, the schools are going to be benefited so much more.
$300 contribution could cost you as little as $20, $30. Is that fair to say?
Exactly.
Yeah. Other qualified charities, Idaho Youth Ranch is a great example. Idaho allows individuals to take up to a $400 deduction for contributions to places like the Idaho Youth Ranch, receiving the same benefit that you've outlined, $200 credit. It plays the same. So really, collecting receipts from your contributions to Idaho Youth Ranch, it's worth at least $200. Capital gains deduction. If you're selling real estate here in Idaho, there are specific deductions for the capital gains that you recognize here in Idaho. Always be sure that you're having that conversation about real estate you sell here in Idaho. And finally, 529 plans. This is really applicable really in any state in which you have one, but there are state-specific benefits and deductions for having college savings plans for your children.
And in a nutshell, a 529 plan is a higher education savings account. If you put money in there, you get a state deduction. There's no federal deduction, but just know that it's going to grow tax-free as long as that money is used for education.
Thank you. Okay, we're going to wrap up our conversation here talking about 1031 and opportunity zones. And Tim, I want you to stop me at the point at which this is feeling like too much information. Okay. A lot of conversation. I have conversations about 1031s probably on a daily basis. Would that be fair for you to say as well?
Well, with the real estate market, again, being as hot as it is, there is a lot of focus on that.
Absolutely. And so a lot of transactions taking place right now, a lot of large gains being recognized on the sale of real estate. Well, given, as you've said, kind of how rampant the inflation has been on the real estate market itself, a lot of large gains. And so individuals looking for places to park this money so that they don't have to pay income tax on it. 1031 is common in their vernacular. It's known as a like-kind exchange, where they take the proceeds, 100% of the proceeds that they receive from the sale of that property, and put it into another property of like kind. It's a very loosely defined term. I mean, like kind is really just saying, is it a business or investment use property? It can be an apartment complex, farm ground. Yeah, I mean, you probably, like me, you've probably had clients that are concerned that I sold an apartment complex, so I need to find another apartment complex.
Right.
But really that isn't the case. You just need to find property that's both business or investment related. The red light there is you can't be investing in a personal residence or something like that.
But the IRS has made provisions to get you into a personal residence as long as initially it's something else.
That's right. So that's what, a 2 to 3, maybe 5-year game plan that you're looking at
The
there?
IRS has said 2 years.
Okay,
If you can show that for 2 years it wasn't tainted as personal.
got it. So you like kind of exchange into another home, it's rented, it serves an investment and business purpose, and then you eventually move into it at
Yes.
that point.
Then you can convert it.
Converted at that point. So a thought there. Like kind exchange, though, just so everyone knows, was challenged a little bit by the Trump tax laws. It had to do with something known as recapture. In the past, pretty much everything that was a building, you could roll that gain into a new replacement property. That changed a little bit, though, with the Trump tax laws, where they said, well, any purchase of appliances or retro, molding, millwork, things like that, it became more difficult to roll those gains into a new property. So the workaround there has been kind of multifaceted.
Well, and it goes head to head against the cost segregation strategy we talked about a minute ago.
It does, because if you cost segregate a building and say, okay, I bought this building for $1 million, I've cost segregated it and put all of these, I now have a bunch of molding, millwork, specialty electrical that I've put in all these buckets and written off in day one, and then you decide to sell the building. It's like, well, you really haven't done yourself any favors. You're kind of where you started, So this has required a lot of individuals that do 1031s to have more in-depth conversations with their CPAs about how to do this effectively. Conversation number one is that the building that you're 1031ing, was a cost segregation done on it in the past? If so, talk about special allocation of those proceeds. Talk about the replacement property and doing a cost segregation on that new replacement property in connection in the same tax year as the like-kind exchange. Those are important things to talk about. Whether or not to make a charitable contribution of the assets that were cost segregated right before the like-kind exchange as well. There's about 3 or 4 things that can be done leading up to that are very intelligent things to consider leading up to it. Anything else come to mind outside of those 3 or 4 things?
No.
I'll add to that opportunity zones have been kind of a buzzword for the last 3 years as well. It's an ability for an investor to invest into a low income community, into a project that the governor has identified as being, a target for their reinvestment. Investment into those things are going to create for any taxpayer an ability to defer a gain actually a lot more effectively than they could with a like-kind exchange. It comes at the cost, though, I think, Tim, of wondering whether or not are you investing in something you believe in?
Exactly. And I think, both of these scenarios require a commitment.
They do.
You mentioned the recapture. That's a commitment to that you're going to be in that building for a while and not go aggressively after the write-offs. I think the qualified opportunity zone requires a commitment that you're willing to park that money for a specified amount of time.
Right. Sometimes up to 10 years, parking it for a long period of time. And in my opinion, the opportunity zone is really, I think, a fit for an individual that isn't necessarily real estate savvy. They have a proceed, let's say, from the sale of their business that they would like to just invest in something else. Identifying the right opportunity zone fund might be a great use of that money. Now, this is conversations they need to have with their financial advisors really when it's all said and done, because as I've mentioned, these are generally low income communities. They are generally investment projects that investors may otherwise not have been incentivized to invest in. And so identifying and evaluating the merits of that investment are the important part of going into a qualified opportunity zone fund.
Well, and it also needs to be weighed against the conversation we had about the long-term capital gains rate.
Right.
I mean, if you believe that that rate is going to go up, maybe you're better off to pay the tax this year.
Agreed.
With its 20% ceiling versus a 28 you may be looking at in a couple of years.
That's right. This may just be a year where you throw your hands up and say, I'm paying tax. You know, the rates are more favorable now than they've ever been.
True.
Just for everyone's edification on how an opportunity zone works, you don't have to be selling a building. It can be a capital gain generated from the sale of stock, from your business, from a building. It can be from anything. You take the amount of gain and reinvest it into an opportunity zone within 180 days of that gain. And the gain is effectively deferred at that point.
So the vehicles for investing those, do you go buy the property yourself?
There's two ways you can go about doing it. You can bootstrap it yourself and identify a property that qualifies and invest into that property directly, or you identify an opportunity zone fund that amalgamates a lot of these investments into a partnership, and you invest in that partnership saying, I'm buying an interest in that partnership. Financial advisors, often are aware of some qualified opportunity zone fund opportunities, things of that nature.
Maybe a little more liquid, maybe a little more diversified.
It would certainly be more diversified. They have a 90% purity requirement that they have to say that 90% of the investment within that opportunity zone fund is invested in properties that are in fact in opportunity zones. So you got a little bit of leeway there, far more diversified. If the goal is a more maybe risk averse investment, a fund may be the better route to go. It might be. The money goes into the opportunity zone fund. After 5 years, 10% of your initial gain goes away. 10% of it just goes away entirely. After 7 years, another 5 goes away. So let's say that you sold a building for $1 million. Okay. Your basis in it, let's say, was $300,000. So you have a $700,000 capital gain. You invest that $700,000 into an opportunity zone fund. After 7 years, 15% of that gain effectively has gone away. So you've saved $130,000 in gain just there alone. 100, sorry, my math is a little rich there. 105. After that, though, after that 7-year anniversary, there is a mandatory recognition of the other 85% of the gain. So kind of at your 10-year anniversary, I guess you could say, there's a mandatory recognition of that gain, which I don't think a lot of people need to fully understand before they go into a qualified opportunity zone fund, is that either you need to plan on selling that thing on its 10-year anniversary or be prepared to pay the tax associated with that at that time frame. Does that make sense?
Yeah.
Yeah, it's kind of tough.
But if you can pass that along through inheritance, someone will get to step it up.
That's right. Now, the great news is that, qualified opportunity loans also get the further benefit of that if you hold that thing after 10 years, all appreciation you've had on that, you're going to get tax-free. So really, it's about managing the initial gain and whether or not you're ready to pay that gain on that anniversary date. So we've talked a little bit about actively participating real estate professionals in their ability to utilize losses. I think my takeaway, Tim, is that every client should ask, do I have any passive loss carryovers? If they do, have a conversation.
And just one point I want to bring out on this slide is we've seen a huge upswing in the number of people that are getting into the Airbnb market, the short-term rental market. And there are a lot of special tax laws surrounding that. If you rent a property, residential property for 30 days or less, it's different than a long-term rental. It's considered ordinary income as though you were running a hotel. And so it's subject to ordinary tax rates. And sales tax become a hot area for the state of Idaho to collect sales tax on those rentals, nightly rentals. But there are also provisions that say if you occupy it for 14 days or less, you don't have to recognize it.
Right. There's a funny case with Tiger Woods renting a home for 3 days in southeastern U.S. for $180,000. That was a tax court. We'll have to look at that together at some point. Additionally, and if you have rentals too, again, I think just the conversation about what it means to actively participate in that rental too. Generally, your rental losses are going to be limited to whether or not you have other sources of passive income. However, if you can demonstrate active participation in it and you meet certain income thresholds, you can deduct up to $25,000 of that loss annually. So some unique opportunities just to talk about how involved you are in your real estate. The more involved you are, the more freedom you have from a tax planning standpoint. Tim, what's on your mind for estate planning?
Well, I'm thinking about it a lot. The 2017 tax reform effectively doubled the amount a person could give away in their lifetime without being subject to estate tax. Presently, a person can give away $11.6 million in their lifetime without being subject to estate tax. Double that for a married couple, and we're looking at a pretty healthy amount. Very few Idahoans are going to be subject to estate tax. But we know that the tax reform, that part of it, is going to sunset in 2025. We haven't seen anything that would indicate that it's going to be permanent or extended at this point. Joe Biden has said he doesn't plan on keeping that at that amount. The Democrats would like to see that reduced. So we're working with our clients to put things in place that we could readily pull a trigger and get assets out of their estates so that they wouldn't be subject to a much lower threshold of estate tax.
Right. Add to that what we discussed previously about taking away the step up on the those capital gain assets as well. I think that certainly this is an opportunity for individuals that find themselves maybe in excess of their gross estate, being in excess of that 23 million, to have a good conversation about whether or not a gifting strategy would be a wise thing to consider right now. Consider the sufficiency of maybe life insurance proceeds, just quantifying really what the potential exposure is there.
And I would say here again, we have a lot of tools at our disposal to handle this so that even though you're gifting away ownership of these assets, there are mechanisms in place that allow you to exercise significant control over it and still enjoy the benefits of the assets.
Agreed. Final thought, really every client that I sit down with for tax planning, we go through each one of these items. So these are universally applicable tax planning ideas. Whether or not you employ them is a separate matter entirely. But this is a good time to just talk about each one of these. So let's take a brief moment, quick highlights. Retirement plan contributions, we're talking about 401k contributions, SEP contributions, traditional IRA, and if possible, Roth contributions as well. Whether or not a backdoor Roth contribution makes sense as well.
How about putting your spouse on the payroll?
Putting your spouse on payroll and having them contribute to a solo 401k as well? Absolutely. So those that have need of deductions and looking for pre-tax places to put the money, retirement plan is one of the safest and at least from a tax risk perspective, one of the safest places they can look. HSA contributions are my favorite. They check every box. I don't think people understand this. The HSAs are perhaps the richest benefit that they provided in the tax law. It goes in tax deductible, it comes out tax-free, and grows tax-free as well. Sure, you can only do $7,000 a year, but find me something that does this in the tax law.
Exactly.
And HSA is the only thing that does that. Now, you have to have a qualified health insurance plan to have one, but if you do, HSAs are a no-brainer.
And there are provisions for people over the age of 55
to convert
or 50 to put in more.
Yeah, they can put in more or convert them to an IRA if they like. A criticism I've heard from clients saying, we're very healthy. We don't spend money on health insurance and on health related matters. And my argument to them is that this isn't about today. An HSA is about when you're aged, when you will have medical expenditures. I mean, don't they say that statistically individuals over 60 spend a third of their money on healthcare as it is anyway?
Yeah, it's a long-term care plan.
It is. And so in my mind is that it's not about today, it's about how the money will eventually be used. And this is a great way to use that money tax-free.
Good point.
So charitable contributions, you mentioned the standard deduction at $24,000 and how so many more are not itemizing anymore. How does charitable contributions play into that?
People like to give to charity. They like to do it as part of who they are. Most people that we work with donate regularly. If the new standard deduction precludes you from getting any tax benefit from that, There are ways that we can get around that. One is to bunch it up. Maybe we donate once every 3 years. Maybe we donate every other year. You can do that to say, in the off years, I'm going to take the standard deduction because the government's offering me $24,000. And in the years that I do contribute, I'm going to make sure that my total of my itemized deductions is more than the $24,000. My property taxes, my mortgage interest, my charitable contributions. And if you have concerns about making your donation to a charity all at once, there are things called donor advised funds. You can give money to a trust, and then over the succeeding years, you can tell the trust where to spend that money. You get the donation when you fund the trust.
Excellent. So great planning opportunity there, just retiming when you decide to make those contributions. Self-employed health insurance deduction. If you're self-employed and you're paying for health insurance, please be sure that that's being caught above the line, being deducted there. That does not need to go to an itemized deduction. That is the deduction today. Active versus passive income management. Best question I think that any taxpayer can ask is whether or not they have passive loss limitations that are accumulating on their return. There's always opportunity to look at that, to talk about what's contributing to that accumulation of passive losses.
And this is something I like that you do, Dan, is your grouping elections.
Mm-hmm.
If the businesses that you're involved in are closely related, they can be grouped to overcome this passive loss limitation.
Absolutely. Compensation to children is an area of conversation as well. If you have children that are involved in the business, the development of that business, there is things that can be done in management of your tax liability by utilizing what advantages they have and whether or not they need to file.
Or if some of the expenses that you're paying on their behalf could be construed to be compensation.
That's exactly right. So, an obvious conversation point there as well. Business use of home and other related deductions. So rental use of home, you talked about that 14-day and that 30-day rule as it relates to rental use of home. Perhaps there's something that the business owners can consider as well, whether or not that rental use is from a business that they have, or if there's something there that they could be advantaged or benefit from.
Yeah.
Finally, private foundation. This is for individuals that, are looking for, it's really, in my opinion, kind of like a donor advice fund on steroids, kind of is what it is. Is that fair to say?
It is.
Kind of functions the same, where it provides for you the write-off in the year in which you want to do that. But, private foundations obviously can have their own initiatives. They have a hard time collecting public money,
Mm-hmm.
but, they're oftentimes used in support of existing 501c3s as well.
Well, and I would say that, with so many people retiring at this point and retiring wealthy,
Mm-hmm.
Knowing that they have funds that they're not going to spend before they pass away, and knowing that their offspring are taken care of,
Mm-hmm.
Definitely something to consider. These are getting cheaper to administer all the time.
Mm-hmm.
To set up your own foundation that would memorialize your life and allow you to pursue the interests that you're passionate about.
Right. I love it. Well, Tim, with those thoughts, I think we're at the conclusion of things that we plan to discuss. It's great chatting with you, Tim.
Well, good visiting with you, Dan. It's been a marathon.
It has been a marathon. Thank you to all of you that have listened today, that have participated. Likely the conversation today has initiated some questions in your mind, maybe some things that you'd like to explore. Cooper Norman is here always as a resource. Again, encourage you to do tax planning. This is a unique year, and one that I think, absent some meaningful tax planning, possesses great potential for missed opportunities.
Agreed.
So with that, Brooke, I'm going to turn the time back to you.
Wonderful. Thank you, Dan. For everyone that's in attendance, the replay of this webinar, as well as a copy of the slides, will be sent out to everyone that registered. So keep a lookout for that in your email box, and have a wonderful rest of your day.